Good morning, everybody, or good afternoon, depending on where you're joining us from. We'll go ahead and get started. It is 11:30. Thank you for joining us today. Welcome to today's webinar, 5 Smart Investing Principles, brought to you by Royal Wealth Management. This is the second in a series of webinars you can attend monthly. We're holding these on the second Tuesday of every month, starting at 11:30 a.m., lasting between 30 and 45 minutes, maybe a little shorter on some of the topics. At Royal Wealth Management, we understand the significance of supporting your financial goals and fostering a culture of financial wellness. These monthly webinars are part of our commitment to helping you pursue financial well-being by equipping you with the tools and knowledge necessary to make informed financial decisions. So we know there's no shortage of self-help material available out there for people looking to boost their investing knowledge. You have, the TV with TV programs on CNBC like Smart Money and things like that. You have magazines like Fortune, Money Magazine. You have podcasts, webinars like this one. But basically, you can find all kinds of information out there, and you can read about the best of this or the most important that. It can be easy to get really confused out there, especially when you're getting conflicting ideas. Understanding a few investment principles can be a great place to start, and it can give you a better framework to understand the information as you take in these ideas. So it can also provide context for evaluating the concepts and strategies that might be suggested to you. So this presentation goes through 5 smart investing principles. These are key concepts that could help you understand what it takes to create an investment portfolio that's designed to pursue your investment goals. Before we get started, let me tell you a little bit about myself. My name is Darren Royal. I'm the president and owner of Royal Wealth Management. My firm's been helping clients pursue financial goals for over 20 years now. Royal Wealth Management was founded to assist clients in every aspect of their financial lives. We strive to help create financial stability and security for each of our clients. We want to provide people with the tools that can help them make informed decisions. We offer a lot of informational material out there on a wide range of topics, from retirement planning, estate planning, risk management, investing topics like we'll talk about today, because we understand that individuals have a diverse financial needs. So all topics may not be prevalent to certain individuals out there. If you have any questions during the course of this presentation, we'll provide additional instructions at the end of the presentation on how to get questions answered. So keep in mind that the information in this material is not intended as investment, tax, or legal advice, and please consult a professional for specific information regarding your individual situation. All right, so let's get to the meat of our topic here. So there's 5 smart investing principles that are helpful to understand if you want to potentially break the cycle of that buying high and selling low. Are there a lot more investing principles out there? Absolutely. But we're going to cover 5 of them for our purposes today. We're going to focus on topics that we believe are critical for you to understand. The first one is estimating your time horizon. How much time do you have to invest on certain goals? Do you have 3 years? Do you have 30 years? So you want to understand how long you have to invest so you can pick the right investments and the right strategies out there. Number 2, you want to know your risk profile. What type of an investor are you? Are you an aggressive investor? Are you conservative? What types of strategies and investments are you going to be able to hold to allow you to sleep at night, but still reach your financial goals? So you want to understand what your risk profile is, and can you handle ups and downs of the market? Thirdly, we're going to talk about diversification. Diversify, diversify, diversify. That's right, we said it 3 times. Similar to how people talk about real estate, it's location, location, location. Diversification makes up, there's a study out there that diversification makes up 91% of how your portfolio is going to perform. So it's important to understand how you diversify. Fourth, we're going to consider taxes and inflation. Now, these are those hidden things that eat into your returns over and over and over. So we'll talk about how taxes and inflation can eat into those returns and strategies to help you avoid that. And fifth, we'll talk about getting started now. Now, it may make sense, but you can't change what's happened in the past. But the only thing you can do is start today. So with the material, the education that you get, you just want to go out and start using those principles right away to reach your financial goals. It's all about getting started now, not beating yourself up about what you could have or should have done before. Let's take a look at our first principle, estimating your time horizon. You generally start with how much time you're going to have to invest. So it might be short-term goals that you have, like putting a down payment on a house or buying a car. Those may be shorter-term goals like that 0 to 4 years. You may have midterm goals, which are typically 5 to maybe 7, even 10 years long. Those may be saving for education for your kid to go to college. So those are longer term goals. With each step up and a little bit longer, you can afford to take a little bit more risk. Why do we say this? Because volatility is in the market. It's just part of what makes up the markets. On average, we have a 5 to 10% correction at 3 to 4 times every year. You have a 10 to 20% one time a year. On average, you have what we call a bear market. The market's down over 20 to 30%. You have that about once every 4 to 5 years. And over the last 25 years that I've been involved in this business, I've seen 2 of them out of 5 bear markets that have been down over 40 to 50%. So that's why you want to look at those longer term. If you have longer term goals at 10 plus years, you might be able to afford to take a little bit more risk, right? Because the volatility, you can ride the ups and downs, where in the shorter term, midterms, you may not be able to, so you don't want to take as much risk in those time frames. So the first thing you want to understand is how long do you have to invest? Let's move from estimating your time frame to our next principle. So know your risk profile. How much tolerance do you have? So it's easy to say, I can handle a high level of risk. I often have investors come to us and say, yeah, no problem. I can handle 20, 30% down move, until we actually suffer a 20 to 30% down move. As Mike Tyson famously said, everybody's got a plan until they get punched in the face. You want to make sure that you have a good plan for your risk tolerance so that you can stay in the market. What happens to my outlook if the value of my investment drops, right? How much could I lose and stay in the market? When is that time that your fear is going to get to you, the best of you, and you're just going to have to sell out? So you want to make sure that your strategy is conducive to how you handle that fear and greed decision. It's also helpful to ask yourself, how would I describe my investment knowledge? There are some, television programs out there that we mentioned, like Mad Money with Jim Cramer, that help people understand investments and how markets work. But if most of your investment knowledge has come from television personalities, you may want to consider getting a second opinion on your approach. So how much knowledge you have can depend on what types of investments and strategies you're going to use as well. Here's another helpful series of questions to ask yourself. What would you rather have? $500 right now, or a 50% chance at $2,000? Many people go for the $2,000, and rightfully so. Since you have a 50-50 chance, the decision tree shows the $2,000 answer carries a potential value of $1,000. So let's add a few zeros and see if that changes your perception. What would you rather have? $50,000 right now, or a 50% chance to win $200,000? The decision tree stays the same and says the opportunity to win $200,000 has the highest potential value. But in reality, many people second guess that decision because $50,000 is a lot of money. Remember, there's no correct answer to these questions. They simply help you better understand the concept of risk and your risk tolerance, which is one of the more important things to understand when you're selecting your investments and your investment strategies. Investment risk can be managed, but it can't be eliminated entirely. All investments carry some level of risk, and in general, the greater the risk the investment carries, the higher the potential return. This illustration may help you understand how it works. Along the horizontal axis is risk, and the lowest level is on the left and the highest on the right. Along the vertical axis is the potential return. The lowest is at the bottom and the highest at the top. So as you can see in this illustration, to the left, we have the most conservative and least volatile investments, like cash alternatives. These could be things like CDs, money market funds, which currently are actually getting some pretty decent returns, upwards of 4, maybe 5%, if you can find it out there. These tend to be better off for those shorter term goals that you have out there, that 0 to 4 years. If you need your money, you don't want it to in a shorter period of time. You don't want the volatility and risk having to pull out when the markets might be down. Next up on the risk spectrum is debt. This can be bonds issued from corporations or municipalities or the federal government with treasury bonds. These take on a little bit more risk than what the cash alternatives do. There's no guarantee you'll get your money back, but it is a contractual obligation that as long as the organization that issued the debt does not claim bankruptcy, they would pay back your full principal and as well as the interest payments along the way. This tends to be better for those short to medium term investment goals, like maybe saving for kids' college if it's closer. If they're 3-4 years away in high school, you may not want the volatility that you had when they were a newborn and you were just getting those investments started for. Then next on the spectrum is stocks. This is where most people lie with their risk parameter or their higher risk investments is the stock market. It's easily accessible to most people through mutual funds, exchange traded funds. They can get involved through their 401ks or other retirement plans at work. But stocks carry a little bit more risk than bonds and cash alternatives do. So you definitely want to use this in your mid to longer term investment time horizons. 10 plus years, you can really afford to roll with the punches when it comes to the market. There hasn't been a rolling 10-year period where the S&P 500 hasn't, or 20-year period where they haven't had a negative return. As long as you can ride out the longer term, you can ride out the volatility of the stock market. Then next and finally up on the risk spectrum is speculative. This could be things like trading stocks, or you're looking at investing in commodities, or you're speculating in cryptocurrencies, or other things like that. There's all types of speculation out there. You can do different types of real estate investing, maybe more speculative as well. If you're doing more shorter term rentals like Airbnbs. Speculative investments, though, you want to focus on longer term, and you also want to focus on smaller positions of your overall portfolio. If you have all three of these other ones in your portfolio, then you might be able to speculate with a little bit. We like to take what we call asymmetric bets, where we may invest only a small amount of money that if it went to zero, it would not change our lifestyle now or in the future. But if they hit, it could be a large payout for us, and that could change our lifestyle. We like to look for those asymmetric bets when we're looking at speculative types investments. Risk can come in all different. So for example, there's external risk that may influence the price of a stock. That is sources of risk that are outside the company's influence. These include economic risks, market risks, interest rate risks, if the rates are moving up and down, which we've seen interest rates move up recently, political risks, like things, war going around in the world, like places like Ukraine, and tax risks. So do you have risk of your taxes going up? Those are types of risks that are external. Let's take a closer look at one of those risks, market risks. Now, if the overall stock market trends lower, many stock prices would be expected to trend lower as well. Conversely, if the market trends higher, many stock prices may move higher. Like the old expression says, a rising tide lifts all boats. So the tide moves up and down, most stocks will move up and down with the markets. On the other side of the scale are company-specific risks. Now, these are risks that are unique to the company, such as delayed product launch. If the Apple iPhone doesn't come out on time, or unexpected expenses. We had a lawsuit that they had to defend. Supplier problems. We saw a lot of that during COVID, where suppliers couldn't get their goods. And management shakeup. Maybe a CEO got fired or something. By buying stocks in an individual company, you're agreeing to accept a certain amount of company-specific risk. The next investment principle that we want to talk about is diversification. I mentioned earlier how important it is to diversify your portfolio. Diversification suggests that a portfolio of different kinds of investments on average may potentially yield a higher return and pose less risk than an individual investment would. In short, diversification helps manage company-specific risks we illustrated on the previous page. So think about it this way. Let's assume if we have an investor of $750,000 to invest. On the left side, the hypothetical example, the $750,000 is placed into one single investment. On the right side, a hypothetical example of the same amount divided between 3 investments. Diversification is the approach to help manage investment risk. It does not eliminate the risk of loss if the security price declines. After 20 years of these investments, the single investment, assuming a 5% annual return, will have grown to roughly $2 million. During that same period, we had different investment returns for the 3 different investments. But the overall portfolio has grown to just over $2 million, so we exceeded the single investment. This example, we're assuming that one of the investments was a total loss. That is, it was worth nothing at the end of the 20 years, but we had an average return of 8% on one of the returns on one of the investments and 6.5% on the other. Although the other one went to zero, we still outperformed overall with a single investment and probably with less volatility. Now, there's a lot more to diversification than simply spreading your money around different types of investments. In principle, you want to select investments that have a low correlation with each other. You want to select investments when one of them zigs, the other one zags. That is, investments that don't tend to behave the same in a market environment. One measure of correlation is called the beta. Beta is a measure of stocks correlation with the overall stock market. Beta is a measure of how likely a stock is to move up and down as the overall stock market moves up and down. So in this example, we're using the Standard & Poor's 500 Composite Index, or the S&P 500, to represent the market. So it has a beta of 1. A stock price that may vary more widely than the S&P 500 would be expected to have a beta that is greater than 1. A stock with a beta of 2, for example, will rise and fall on average by twice as much as wider stock market does. So if the S&P 500 falls by a hypothetical 1%, stock with a beta of 2 would be expected to drop by 2%. Beta can also be negative. For example, a stock with a beta of -1 would expect to see its value fall by 1% when the market rises by 1%. So we have reviewed our hypothetical examples used for illustrative purposes only, and they're not representative of any specific investment past performance. They're not guaranteed of any future results. Another investing principle is in consideration of taxes and inflation. Also fees. You want to consider your fees in this as well. And this chart shows how many days on average in America will work. This is back in 2018. Forgive me for the data being a little bit old, to pay their tax obligations. Americans pay income taxes, Social Security taxes, sales and excise taxes, and property taxes. Back in 2018, it took an individual 44 days of work to pay for their income taxes. 26 days of their work went to Social Security, 15 to sales and excise, 7 days went to corporate income tax, 11 to property taxes, and 6 days they worked to pay off or for other taxes. So 60, 75, what is that, 85, 86, almost over 100 days that you're working to pay for taxes. Another silent thief you need to watch out for is the effect of rising prices, otherwise known as inflation. Now, inflation hadn't been that bad up until the last couple of years. We really saw it move up above that 2% inflation. In fact, at one point in time, a couple of years ago, it got as high as 9%, which can really eat into your overall savings and investment returns. Over the long term, inflation erodes the purchasing power of your income and wealth. It's easy to see if you just look at prices from 1967. If you go back, a new house back then cost $14,250. Average income was $7,300. A gallon of gas was only 33 cents. A new car only cost $2,750. Now, last year in 2023, the average home in the United States was over $430,000. Average income was just a little under $75,000. A gallon of gas cost $3.86, and the average new car cost over $48,000. Other inflationary areas that we've seen huge inflation are in education costs for children to send them to college, and healthcare, which is going to be probably one of the most expensive, the highest expenses that most people will have in retirement. We've seen that inflation even outpacing the average inflation rate of that 2 to 3%. Our last investment principle is to get started now. Procrastination can be very costly to everybody in all facets of our life, right? For example, if you were to deposit $250,000 in an account earning 6% at the end of 20 years, your account would be worth $800,000. If you waited just 5 years before starting that investment program, the $250,000 would have 15 years to work and would grow to $540. That's $200,000 less by waiting just 5 years. And if you waited 10 years, then started the program, you'd only end up with $447,000. Put another way, waiting 10 years to start was a $350,000 decision. So as I said earlier in the program, it's not about what you did before, it's about what you can do from today going forward, and that is to start now. Now, when you're ready to move forward, we've identified some specific action items to help you get started. First, you want to put together a personal income statement. You want to identify all your sources of income and where your money is going. So all your expenses. On one side, you have all your income, whether that be from work, your salary, your bonuses, if you have commissions, if you have a private business, if you have stocks and bonds that pay interest rates or dividends, if you have rental real estate, you want to include all of your income and then compare that to all of your expenses outgoing, utilities, your mortgage if you have a mortgage, whatever that may be. For the business, if you have expenses there, you want to include all that for real estate. So if you have investment real estate, any upkeep that you got to put into the home, anything like that. Then you want to put together a simple balance sheet or what we call a net worth statement. This should give you a good snapshot of your assets and liability. You want to list all of your assets on one side. This would include investments and business again, any real estate you own, any jewelry or family heirlooms, things like that. You want to have all your assets listed out against any debt that you may have out there or liability. That may be a mortgage or credit cards or a car payment or a car loan or any personal loans. Things like that would be all on your debt or liability side. That will give you your net worth. And then you want to identify your long-term, medium-term, and short-term goals. So again, we talked about what short-term goals might be. That might be buying a new car in 3 years, or planning to put a down payment on a house, or maybe it's down payment on a second home, or a vacation home, or a rental home, whatever that might be. Medium might be paying for your kids' college education, or it might be starting a business in 5 to 10 years that you want to do in retirement or something like that. Long-term goals may be retirement. You may have 10, 20, even 30, 40 years until retirement. So those will be your longer term goals. And then you also, we talked about, you want to determine your risk tolerance. Now let's be honest with yourself about your risk tolerance for how much you can handle of risk. Can you stomach big market swings, or are you more comfortable with less volatility? Like I said, over the past 25 years, I've seen 2 bear markets that have been down over 40 to 50%. Could you afford to lose half the market, half of the value in your account, and still be able to hold on and invest for the long term? And once you've sized up your personal finances, you may be ready to discuss your situation with a professional. Following a few smart investment principles can make your investment efforts much more effective, but it doesn't end there. Effective investing requires an ongoing effort, and there's a lot more to know. It's like a gym membership. Just because you sign up doesn't mean you're going to go and get in shape. Like investing, it takes commitment, patience, and a plan. Now, here are some questions that arise at different stages of life, which we'll go through. So Anthony and Selena have a growing family and wonder, what's the best way to fund our children's college education? So they may want to look into something like a 529 plan that has age-based investment funds in it. What are age-based funds investments? Those are funds that get more conservative as we get closer to the point they would be going to college, around that 18. So if you started it when they were a baby, in every 3 or so years, it gets a little bit more conservative, and what they do is add a little bit more bond exposure from the equity exposure, where they may have started out at 100%. By the time they're getting ready to go to college, it might be more of a 50-50 balance between stocks and bonds. Dave and Kristen are in retirement, and they ask, should we change the allocation of our portfolio now that we're no longer working? It's a great question. It depends on how much money you have. A lot of people in retirement nowadays can plan on living in retirement for 20, 25, maybe even 30 years. If you retire at 65, there's a good chance now that you could live to over 90 years old. You may be in retirement for over 25 to 30 years. You may still need growth in your portfolio. However, if you've amassed enough assets that you could live off of them without having to grow, you may want to be more conservative in your portfolio. Rebecca is a single woman with a small business, and she wants to know, my business is finally going well. What's the best way to put my extra income to work for my family's future? Well, if she's got a small business, one of the best ways get around paying some of those taxes we talked about earlier, or shelter some of your investments from taxes, maybe to start a employer-sponsored retirement plan. She could start a SEP or a simple IRA or a 401k where she could contribute money for her retirement, for her family's retirement. She also may want to start an HSA, a health savings account, to help pay for health savings either now or in the future. And Isaac likes to do research online, and he asks, does it make sense to watch the market every day and trade on what happens there? Now, it may for Isaac. If he has the time and the commitment and the patience to be a good trader, then you may want to take that. But I would definitely consider that more on the speculative side of investments. But if you don't have the time, you may want to just stick to long-term investment strategies. But there are certain people out there that have made money in trading, and it's certainly an option out there for a strategy for certain individuals. There are a number of strategies you could use to potentially help to invest wisely. And that's where Royal Wealth Management comes in. We specialize in helping people just like you assess their investing strategies as they work to pursue their goals. And we invite you to take advantage of our complimentary 30-minute consultation. You can book a time directly with me by using the middle QR code and schedule 30 minutes to ask me anything you want. To stay up to date on our additional educational opportunities, be sure to link to us on LinkedIn, and don't forget to check out our website. There you can learn more about Royal Wealth Management and sign up for our monthly newsletter. So please take advantage of these resources. As I mentioned earlier, if you have any specific questions that you would like to answer and don't want to sign up for a 30-minute consultation, you can email me at darren.com and we will get back to you right away. Or you can just give us a call at 720-733-9143. And that concludes our webinar for today. So I appreciate you attending. Thank you, and I hope that you all have a great day. Hope I didn't have any attendees.